everyone, I'm Amanda with RetireWise, and today we're here with Sean, and we're going to be talking a little bit about market volatility. So we'll jump into the first question here. What is market volatility, and how does it impact retirement portfolios?
Yeah, that's a loaded question, right? Everybody's favorite topic outside of taxes. Taxes and market volatility, aren't those powerful tools? No, they can be really devastating. But market volatility is when the market has these dips and swings in the market. So you see the ups and downs, this Wall Street roller coaster, and you see your portfolios. You may hear the news of, the market went down so much today or up so much today. The volatility is the swings from one point to the other, right? And when we're accumulating, you're going to go through those swings and you kind of ride those swings out and you're still putting money into the accounts. Well, the difference is in retirement, we're taking money out of our accounts. We're not putting money into the accounts. So that volatility becomes a lot more critical for a couple reasons. We're not putting money in and we have a shorter time frame to get through that time frame. We just can't sit by and wait for everything to recover because we got 20 years before our retirement, right? So the power that happens is what happens in those dips, right? The power in the dips. It's what you do in those dips. In retirement becomes kind of powerful. Mm-hmm. It's being strategic in those dips, what kind of investments you're in, how to control. You can't control volatility. You can't control the markets, right? If we could do that, we all wouldn't be sitting here, right? We have no control over that whatsoever, but you do have control of what your investments are in, your strategies in retirement, the right kind of accounts that you're in, and the right kind of strategies to navigate through those dips. And here's one of the biggest things too is, like I mentioned, if you're taking money out, right, in retirement, which we're doing, and the market's going down at the same time, one of the biggest hits on your retirement account outside of healthcare is a thing called sequence of returns risk. It's when you're taking money out of your account when the market's going down from that volatility. That has to be controlled. It doesn't mean that you just don't take anything out. You have to set up an array of different strategies, different kind of accounts, so you can take money out of those different accounts when the market's going down. It sounds complex. It's really not, right? This is what we do all the time. We love doing this stuff. There's not a single kind of investment out there or vehicle that can solve all the different risks, including market volatility. It requires multiple types of different diversification, including different types of accounts. So that's one way to go through there. It's just putting out the right strategies. And there's not a magic pill, right? It's not, hey, I'm going to tell you to do this and it's going to happen. Mm-hmm. There's some strategic movements that have to happen, and it could be different for each person out there. But there are ways to limit your downside. Market dips are going to happen. There's going to be swings. There's going to be ups and downs. You're going to gain. You're going to lose. But it's just a matter of trying to navigate that. It becomes more critical in retirement.
Yep, absolutely. All right, so what role does an advisor play in helping clients stay calm and focused during volatile markets?
So the funny thing about this is, right, your money is emotional to you. Not that it's emotional to me too, but I get it. It's your money, so it's your retirement. It's super emotional. But what happens when we have those emotions? Mm-hmm. Knee-jerk reactions, right? Knee-jerk reactions. We help eliminate those knee-jerk reactions. Here, folks, you're seeing things on the news all the time. We try to be proactive, put out videos, put out articles, those kind of things. We hear things in the news. Hey, this is how it affects you, right? But first of all, I would just tell you not to listen to the news, right? Just let us tell you what's going on, right? But you hear things in the news, and all too often, things that happen in the news have no effect on your portfolio. Or the stock market may react, and the markets may react to a news event that really has nothing to do with all those other stocks that just went down. Mm-hmm. It's just the nature of the beast of these days with the way news travels. It's all at the speed of light. It's on our phones. But here's the thing is you got to not make knee-jerk reactions. Make informed decisions. Mm-hmm. Those knee-jerk reactions are going to cost you down the road. You're going to pull money out prematurely at the wrong times. You can't time the market. You got to be right twice. When to get in, when to get out. That's nearly impossible, right? Take the emotions out. That's an emotional roller coaster. It's painful. So having a third party or a financial advisor to sit there and look at it and guide you and say, just wait, it's all right. It's all right. Just stay calm. We got you, right?
I feel like that takes out the feeling of like I have to like do this on my own. Like 100%. They have somebody looking out for them.
100%. We're walking alongside you. I relate it to this way too. So marketers are geniuses, right? You walk into a store and things are placed at a certain point. You watch a TV commercial, things are done a certain way to trigger human emotions and whatnot, right? It's those same kind of emotions get triggered when we see those news events and we're thinking about our retirement money, right? Yeah. It's that impulse buy. I don't want you to make impulse decisions with your retirement accounts and regret it down the road. Mm-hmm. Let us be your guide.
Yeah, that's great. All right, so what strategies can be used to take advantage of market downturns rather than just avoiding losses?
Yeah, so, there's a couple different tools in the tool shed out there for this, right? There's a couple different things. Part of it is First of all, we're going to divide the portfolio up into multiple segments because each segment is going to serve a different purpose. Because in retirement planning, there's different segments that count for different things. Like, first of all, we're going to start with the needs category, and that's one thing that needs to be protected the most, right? Here's the thing, folks. We're going to shift our mindset into a preserve plus grow mode. We're used to growing and accumulating our whole life. I got to put money in. I got to grow. I got to save this money. That's fantastic. But when we get there, we got to switch our mindset to a preserve plus grow. So that means we're not as aggressive in our investments. We're going to get a little more conservative, right? Our investment types we're going to still grow the portfolio. You still got to grow some to save for the future, save for things down the road. But you're going to dial it back a little bit. You're going to have a little bit more conservative strategies. So part of it is being more conservative in your strategies. You're still going to be in the market. You might not be as much in the market because we're going to be a little more conservative. Mm-hmm. But when the investment strategies that you are in the market are going to be a little more conservative, and you may have some plays to get some guaranteed income out. You may have like a fixed index annuity to give you some downside protection. What those do, you don't put all your money in these, right? Because it has to have divided up into the different segments. However, what that can do is help with what Social Security is not paying for. If you have a pension, what pension is not paying for, that may help make up the needs difference. The reason you would use that is it gives you the downside protection. Market goes down, you stay where you're at. You're not losing money. Once you have that covered, then we look into and we start putting money into the next categories. We start investing it into the market, into the proper strategies, right? So it's just all these strategic movements. And again, your plan is going to be different than my plan.
Yeah.
Every plan is a little bit different based on where you're at, what your needs are, and it's just going to be a real personalized plan for you.
Okay, great. How can investors preserve their retirement savings during periods of high volatility in the stock market?
So this gets into, first of all, let's go back to not be emotional.
Yeah.
Right? Let's not make some knee-jerk reactions. However, in prolonged times of down markets, there are going to be some adjustments that we would want to make. Right, when we see headwinds coming, or the headwinds already happen, and we see it going to be continuing a little bit, there is going to be some adjustments to get a little defensive. Right, you're getting a little defensive, a little more conservative. Things that are going to be able to ride these downturns out a little bit. Mm-hmm. There's different investment vehicles that are going to help do that. Now, I can't sit here and say go do X, Y, Z because one, that investment vehicle may change over time and it may not be right for you. Right, mm-hmm. But I can say here is that there are different ways to maneuver to put things in different accounts. Maybe it's anything from bonds to inverse funds to buffers. There's all kinds of different things, right? And the different strategies, diversification, being well diversified across what you're invested in, avoids things that we call fatal fluctuations. What a fatal fluctuation is when everything dips at the same time. Mm-hmm. If we go back to, if people remember 2000, 2008, you got the dot-com bust, you got the real estate and financial crisis in 2008. Everything was down across all sectors. Everything was down, right? But that doesn't happen all the time. If you're diversified and you're invested in different sectors, different segments of the market, different areas, it helps the volatility out a little bit because mm-hmm. it's not often that all of them are take through massive swings at the same time, right? That combined with the right strategies, the right type of accounts, can help you go through that thing. You don't have to go to all cash, right? Mm-hmm. There's people that think about that, but that's extreme, and then you're not fighting inflation. You're not growing your funds for the future. It's just all about putting that right strategy in place.
Yeah, absolutely. All right. Well, that leads us into our last question. How important is diversification in managing risk and reducing the impact of market swings? And we've already touched on that a little bit, but we can definitely talk more about diversification because I feel like it's very important.
No, it's huge. Yeah, I jumped the gun there a little bit. So,
that's okay.
But diversification, and here I'm going to take this opportunity to talk about the different types of diversification.
Okay, yeah,
right?
Absolutely.
So there's two different types of diversification, and all too often people really just know about one of them, mm-hmm. right? And what I mean by that is the main type of diversification is what I call horizontal diversification. That means, what am I invested in? I'm invested in stock A, stock B, bond C, whatever, fund D, right? In different segments. Mm-hmm. You're spreading out exposure into different areas of the market, different areas of the economy, whatever, right? That's horizontal diversification. You need that. It's critical to help fight the fatal fluctuations. That's going to happen, but it's when one area dips and one area doesn't. one's going to be a little less volatile than the other. And there are some strategies for low volatility, but that's just diversification this way. And that's where the majority of people are focused, especially in the accumulation mode. Everybody's just thinking this way, okay? And that's fine, and it's good, and you're going to continue to do that in retirement.
Yeah.
But what we're going to introduce to you is the other type of diversification is you got to go vertical, right? There's a vertical diversification as well, and this is uber critical inside of a retirement plan. It goes back to you need different types of accounts to fully fund and protect and to grow, to get a strategic optimized plan. What that means is you don't put all your money into one type of account, because that limits the maneuverability to take things like help control sequence of returns, to do maneuvers during times of volatility and those kind of things. Different kind of accounts, right? So each account has a different purpose. And we would sit down with people and figure out what are those accounts, what do they look like, what are they? And then so as things happen, look, life's going to happen, economy's going to happen. You're going to have changes in your life while your retirement goes about. The economy's going to throw curveballs here and there. But by being diversified both ways, it gives us flexibility, it gives us tools, it gives us pathways. So when that detour sign comes up, we know how to pivot, right? And that GPS is telling us, oh, that was in my plan, I need to go this way, right?
Yeah, that's helpful, because most people don't think about vertical. They only think about
100%
horizontal, so that's great. All right, well, that is all we have today for market volatility. Be sure to join us next time for more information on how to retire wise.